You paid into Social Security for 40 years. Every paycheck, every job. Every year, your employer matched every single dollar. And for 40 years, you were told the same thing. That money is yours. You earned it. When you retire, it comes back to you. Here is what nobody told you. The IRS has a formula, a specific mathematical formula that the federal government designed and has quietly refused to update for over 40 years, that determines how much of your Social Security they get to tax. Not some of it, not occasionally, not for wealthy people only. For more than half of all Social Security recipients in America right now, up to 85 cents of every dollar they collect goes back into the IRS's income calculation, and most of them have no idea it's happening. This is not a glitch. This is not a misunderstanding. This is a formula that was written in 1983, set at income thresholds that made sense in 1983, and has never, not once in over 40 years, been adjusted for inflation. That's not an accident. Today, I'm going to show you exactly how this formula works, exactly how much it could be costing you, and, most importantly, the specific moves that reduce or eliminate this tax that your financial advisor may never have explained to you. Because the people who know this formula use it to pay less. The people who don't know it pay more every single year. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making decisions about your specific situation. My name is Kevin, and every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let's get into it. To understand why this formula hits so many retirees so hard, you need to understand where it came from. In 1983, Social Security was in financial crisis. The trust fund was nearly empty. The Reagan administration and Congress needed to find money fast, and one of the solutions they landed on was taxing Social Security benefits for the first time in the program's history. Before 1983, Social Security was completely tax-free. Every dollar you received, you kept. Starting in 1983, that changed. Congress introduced the Provisional Income Formula, and they set the thresholds at $25,000 for single filers and $32,000 for married couples filing jointly. At those thresholds, up to 50% of your benefits became taxable. Then, in 1993, under the Clinton administration, they added a second tier. They said if your income is above $34,000 as a single filer or $44,000 as a married couple, now up to 85% of your Social Security is taxable. Here is the critical thing you need to understand about those numbers. They have never been adjusted for inflation. Not in 1995, not in 2000, not in 2010, not today. A combined income of $32,000 in 1983 meant you were comfortably middle class. In today's dollars, that's over $100,000. So every year that passes, every year that inflation rises, every cost of living adjustment Social Security pays out, more and more retirees cross those thresholds and find themselves owing tax on money they already paid into for decades. In 1984, about 10% of Social Security recipients owed any tax on their benefits. Today, that number is 56%, more than half, and it is climbing every single year. That is not a coincidence. That is a revenue mechanism built on frozen math. Now let me show you the actual formula. The IRS calls it provisional income. You will sometimes see it called combined income. Same thing. Here is how you calculate it. Step 1. Take your adjusted gross income. That includes wages if you're still working, pension income, IRA withdrawals, investment dividends, capital gains, rental income, everything on your tax return before deductions. Step 2. Add any tax-exempt interest you earned. Yes, even tax-exempt municipal bond interest counts toward this calculation. This surprises people every single time. Your muni bond interest doesn't get taxed directly, but it counts toward the formula that taxes your Social Security. The IRS closed that loophole specifically. Step 3. Add half of your annual Social Security benefit. Not all of it. Half. That total is your provisional income. Now the IRS applies 3 tiers to that number. Tier 1. If your provisional income is below $25,000 as a single filer or below $32,000 as a married couple, none of your Social Security is taxable. 0. You're in the clear. Tier 2. If your provisional income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, Up to 50% of your Social Security benefit becomes taxable income. Tier 3. If your provisional income exceeds $34,000 as a single filer or $44,000 as a married couple, up to 85% of your Social Security benefit becomes taxable income. Now let me put real numbers on this so you can see exactly what this costs. Meet Robert and Linda. Both 68. Both retired. They live in Ohio. Robert has a small pension from 32 years working for the county, $18,000 a year. Linda collects Social Security of $22,000 a year. Robert collects $20,000 a year. Together, their Social Security is $42,000 annually. They also take a $15,000 IRA withdrawal each year to cover expenses. Here is how their provisional income calculation works. Adjusted gross income, $18,000 pension plus $15,000 IRA withdrawal equals $33,000. Tax-exempt interest, 0. They don't own muni bonds. Half of Social Security, $42,000 divided by 2 equals $21,000. Provisional income, $33,000 plus $21,000 equals $54,000. $54,000 is well above the $44,000 married filing jointly threshold. That means 85% of their combined Social Security, 85% of $42,000, which is $35,700, is now taxable income. At their effective tax rate of roughly 12%, that's $4,284 in federal income tax on money they paid into the system their entire working lives. And here's what makes this situation particularly painful. Robert and Linda did not plan for this. Nobody told them. Their pension income and their IRA withdrawal are not extravagant. They are not wealthy. They are a retired county worker and his wife trying to live on a fixed income. But the formula doesn't care about any of that. Now meet Carol. 71 years old, widowed 2 years ago, lives in Arizona. When her husband was alive, they filed jointly and their combined income kept them just under the married threshold. The year he passed, Carol's filing status changed to single. Single filers hit the 85% tier at $34,000 of provisional income. That's $10,000 less than the married threshold. Carol collects $24,000 a year in Social Security. She has a small IRA worth $180,000. She takes $12,000 a year in withdrawals. Her provisional income, $12,000 IRA withdrawal plus half of $24,000 Social Security equals $12,000 plus $12,000. She is just under the first tier. Barely. Zero tax on her Social Security. But in March of that year, Carol's furnace died. She needed $8,000. She took it from her IRA. That one unexpected withdrawal pushed her provisional income to $32,000. Now, 50% of her Social Security, $12,000, is taxable income. At her 10% bracket, that's $1,200 in additional tax she didn't budget for. And this is something the formula does that almost nobody talks about. Every additional dollar of income you bring in doesn't just get taxed at your regular rate, it can pull more of your Social Security into the taxable zone at the same time. In Carol's situation, that $8,000 furnace withdrawal created about $5,200 in taxable Social Security on top of the $8,000 itself. She effectively paid tax on $13,200 because of an $8,000 emergency. That is what tax professionals call the Social Security tax torpedo. And it hits hardest in the middle income range, typically between $25,000 and $50,000 of provisional income, where every dollar triggers a multiplied tax effect. The Social Security tax torpedo deserves its own explanation because it is the single most misunderstood tax trap in retirement. Here is how it works. In the middle tier, between the first threshold and the point where 85% is already fully taxable, each additional dollar of income you bring in causes an effective marginal tax rate that is significantly higher than your stated bracket. Let me be precise about this. If you are a single filer and your provisional income is in the range between $25,000 and $34,000, the 50% taxation tier, here is what happens when you take an extra $1,000 IRA withdrawal. That $1,000 counts as income directly. It also adds $500 to your provisional income calculation, half of nothing, because it's not Social Security. But it pushes the total up. That $500 increase in provisional income pulls an additional $500 of your Social Security from untaxed to 50% taxable. So you're now paying tax on $1,000 plus $500 equals $1,500 in additional taxable income from a $1,000 withdrawal. At a 12% tax bracket, your effective marginal rate on that withdrawal is 18%. In the upper tier, between $34,000 and the point where the full 85% is already captured, it gets worse. Each additional $1 of income can trigger up to 85 cents more in taxable Social Security. Your effective marginal rate can hit 22.2% even if your stated bracket is only 12%. For retirees in this zone, the standard advice of just take what you need from your IRA is genuinely dangerous, because it doesn't account for the multiplied tax effect every single dollar triggers. Meet Dennis, 74 years old, retired engineer. Lives in Michigan. Dennis has always been careful with money. He and his wife kept their expenses low, kept their IRA withdrawals modest, and for their first few years of retirement, their provisional income stayed below the 85% threshold. In 2004, Dennis's financial advisor recommended he rebalance his portfolio. He sold some appreciated stock, a $22,000 capital gain. He knew capital gains were taxable. He planned for that. What he didn't plan for is that the $22,000 capital gain also increased his provisional income by $22,000, which pushed an additional $18,700 of his Social Security benefits into the 85% taxable tier. His tax bill that year was $6,400 more than he expected, not because of the capital gain alone, because the capital gain activated the formula. Dennis told me afterward that if he had known, he would have spread the sale across 2 tax years. Same stock, same profit, half the tax impact. That is the kind of decision that's only available to people who understand how this formula works before they act. Now let me give you what most videos on this topic never get to, the strategies. Because this tax is not inevitable, there are specific legal moves that reduce it significantly or eliminate it entirely. Strategy 1. Roth conversions during your gap years. The years between retirement and age 73, before required minimum distributions start, and potentially before you claim Social Security, are the most valuable tax planning window of your life. During those years, your income is often at its lowest. Your provisional income is low. You may be in the 10% or 12% bracket. That is the window to convert traditional IRA money to a Roth IRA. When you convert, you pay income tax on the amount you convert. But here's what you get in return. Roth IRA withdrawals in retirement do not count toward your provisional income calculation at all. If Dennis had converted $100,000 of his IRA to a Roth before age 73, his annual required minimum distributions would be smaller. His provisional income would be lower. Less of his Social Security would be taxable every single year for the rest of his life. The tax you pay on a Roth conversion today buys you a lower effective tax rate on your Social Security for potentially 20 years. That math almost always works. Strategy 2. Manage your IRA withdrawals with the formula in mind. This is the strategy that saves Carol's situation. Before taking any IRA withdrawal, calculate your current provisional income without it. Find out exactly where you sit relative to the $25,000, $34,000 thresholds for single filers or $32,000, $44,000 for married couples. If you are sitting just below a threshold, a large withdrawal can catapult you into a higher tier and cost you far more in Social Security taxes than the withdrawal itself. In Carol's case, knowing the formula would have told her, take $6,000 from the IRA now, take the other $2,000 in January when the new tax year resets. 2 smaller pulls instead of 1 large one, same cash. Half the tax consequence. Strategy 3. Use qualified charitable distributions instead of IRA withdrawals. If you are 70 and a half or older, you can donate directly from your IRA to a qualifying charity, up to $105,000 per year. This is called a Qualified Charitable Distribution, or QCD. The critical tax advantage is this. A QCD satisfies your required minimum distribution for the year, but it does not count as taxable income on your return. And because it never shows up as income, it does not increase your provisional income, which means it does not pull more of your Social Security into the taxable tier. If you were going to give to charity anyway, routing that donation through a QCD instead of writing a check from your bank account can reduce your provisional income by thousands of dollars. Same donation. Dramatically different tax outcome. Strategy 4. Delay Social Security to reduce the years of exposure. Every year you delay claiming Social Security past your full retirement age, your benefit grows by approximately 8%. But there is a tax planning benefit to delaying that often goes unmentioned. During the years you are not collecting Social Security, your provisional income calculation is lower because half of your Social Security benefit is zero. That is the window where Roth conversions, asset sales, and large IRA withdrawals cost you far less in tax. Taking Social Security at 62 sounds appealing, but for some people, delaying to 67 or 70 and doing aggressive Roth conversions during the gap results in both a higher monthly benefit and a lower lifetime tax bill. The math on this is highly individual, which is why a tax advisor who specializes in retirement is worth every penny of their fee. Strategy 5. Monitor your investment income sources. Remember that municipal bond interest counts toward provisional income even though it isn't directly taxed. For retirees sitting close to the 50% or 85% thresholds, switching from muni bonds to assets that don't generate reportable income, such as growth-oriented funds held in a Roth, can reduce provisional income without reducing the actual dollars coming in. This is not a strategy for everyone, but for someone sitting $3,000 above the threshold because of muni bond interest, it is worth a conversation with a tax professional. Here is what I want you to do today. Before you close this video, before you go to dinner, in the next 5 minutes, pull out a piece of paper and do this calculation. Write down your adjusted gross income. That's your pension, your wages if you're still working, your IRA withdrawals, your dividends, your capital gains. Everything except Social Security. Write down any tax-exempt interest you earned. Take your total annual Social Security benefit and divide it in half. Add all three numbers together. That is your provisional income. Now compare it to the thresholds. If you are single, below $25,000 is zero tax. Between $25,000 and $34,000 is up to 50% taxable. Above $34,000 is up to 85% taxable. If you are married filing jointly, below $32,000 is zero tax. Between $32,000 and $44,000 is up to 50% taxable. Above $44,000 is up to 85% taxable. Where do you land? If you are above those thresholds, you are paying tax on your Social Security right now, and you may be paying more than you need to. The strategies I just gave you, Roth conversions, QCDs, withdrawal timing, income source management, are not exotic. They are not complicated, but they require knowing where you stand before you make decisions. The 5-minute calculation you just did is the foundation. Let me be honest with you about something that doesn't get said enough. This formula is broken. The fact that the thresholds have not been adjusted for inflation in over 40 years is not an oversight. Congress knows these numbers. They know that 56% of Social Security recipients now pay tax on their benefits. They know that percentage climbs every year. There have been proposals to fix this. Bills have been introduced to either raise the thresholds, index them to inflation, or eliminate the tax on Social Security entirely. Several of them have had significant bipartisan support. None of them have passed. Because Social Security taxation generates over $50 billion a year in federal revenue. That money does not appear as a line item anywhere obvious. It doesn't look like a tax increase. It happens silently through a formula most Americans have never heard of, on income thresholds that were set before most retirees' children were born. The system relies on you not knowing how this works. The person who understands the provisional income formula is the person who can manage around it. The person who doesn't, who just takes their IRA withdrawals without thinking, who collects muni bond interest without realizing it counts, who claims Social Security at 62 without modeling the tax impact, pays more every year. For decades. That is the gap this channel exists to close. Let me give you the complete summary before I go. Social Security benefits became taxable in 1983. The thresholds have never been adjusted for inflation. Today, 56% of recipients pay tax on their benefits, a number that grows every single year. The IRS uses the provisional income formula to determine how much of your benefit is taxed. Your provisional income is your adjusted gross income plus tax-exempt interest plus half of your Social Security. Below $25,000 single or $32,000 married, you owe nothing. Between those amounts and $34,000 single or $44,000 married, up to 50% is taxable. Above those upper limits, up to 85% is taxable. The Social Security tax torpedo means every extra dollar of income in the middle tier can trigger a multiplied tax effect, making your effective marginal rate far higher than your stated bracket. The 5 strategies that reduce this tax: Roth conversions during gap years, careful IRA withdrawal timing relative to the thresholds, qualified charitable distributions, strategic Social Security delay, and monitoring which income sources count toward provisional income. Do the 5-minute calculation. Know where you stand, then talk to a tax professional who specializes in retirement income. Not just a general preparer, but someone who understands this formula and can model your specific situation. The people who pay the least tax in retirement are not the people with the best accountant at April. They are the people who made good decisions in October, in November, in December, before the tax year closed. You cannot go back and fix 2024, but 2025 is still open. I've seen too many good people who worked 40 years, who saved carefully, who did everything right, get hit with tax bills they didn't see coming because nobody took the time to explain this formula to them ahead of time. That's what this channel is for. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell. The next video I'm working on is going to show you exactly how to calculate whether delaying Social Security actually saves you money after accounting for the tax impact. And the answer is going to surprise you. If you know someone who's collecting Social Security right now and has no idea this formula exists, send them this video today. Drop a comment. Did you know about the provisional income formula before this video? Tell me where your number lands. I read every single one, and whatever comes up most is what the next video covers. I'll see you in the next one.